Welcome to the Broken Pie Chart Podcast, episode 280. I'm your host, Derek Moore. A couple of you asked, hey, where's Jay been? Jay will be back on, I don't know when exactly. He'll be back on. Our two schedules have not been able to allow for us to be on the podcast at the same time. But of course, I am keeping track of all my predictions that are working, and I've forgotten the ones that he is getting right and I am getting wrong, because that's just how it goes when you host a show. All right. A lot of people talking about the economy slowing. Is it really slowing? Is it really slowing, or is it just normalizing? Let's take a look at a couple things. And by the way, this week, got some economic stuff. We're going to talk about jobs, unemployment, what's going on there. Some of this talk about, now we're going to get a recession, just like the 29 out of 30 leading economists who predict a recession in 2023. How is that going? Remember, we always say you have to have a little bit of humility being in the markets, meaning you really don't ever know exactly what's going to happen. If you did, it would be too easy in this business. But we're going to talk about that. We got to look at Tesla, some of the interesting stuff in the options market there as that stock has rebounded. And I think it's a good time to go over a little bit on earnings and valuation, but really more about when you think about when you look back or when you look forward, what's going to allow a market to go higher? What's going to make it to go lower? And I got to be honest with you. This is one of these things when I learned years ago, and I started to look at this and just understand, what does it mean when a market goes up? What was the driver of it? So I want to go through that. And maybe we'll talk a little covered calls too. Okay. First thing is, speaking of economists, they have been getting their predictions wrong. What do I mean by that? Bloomberg has an economic U.S. surprise index. There's also the Citi surprise index from Citibank. There's a number of these. And it basically means it's not like, hey, surprise, the market is, the economy's tanking or the economy's doing really well. No. You could have a really positive report, but it's less positive than the analysts thought. And that would be where you would say, it actually underperformed. You could also have numbers that come in worse than expected, and it would underperform the expectations. In other words, let's say the economist said, all right, the unemployment rate is going to be 4 and it comes in at 8. Well, okay, that's a negative. That's a downside surprise. Or let's say they said it was going to be 4 and it turns out it was 1%. That would be a positive surprise. And I will tell you, looking at this chart, the analysts aren't really that great. If you think about, if they get it perfectly right, it's a 0. And then right now it's minus 0.56 to give you an idea of the scale. The last time it was this low was 2015. We did not have a recession in 2015. So I don't think this is what it's saying. What this is saying is that stuff has been coming in worse than analysts expected on the economic front. This is an economic surprise index, nothing to do with earnings per se. At least I don't think earnings are in there. So I know a lot of people point to this, but just understand what it is. I will say, though, with some of the economic data that's been coming out now, and remember, we always say the expected number of rate cuts or the CME Fed probabilities tracker. This is when I look at in Bloomberg. This is the implied rate cuts based upon the overnight Fed funds futures. And the Fed funds futures trade, and they trade at different months. So you have a December contract, you have a February contract, you have a July contract. And all right, this moves around, and this will be wrong in 2 weeks, by the way. So take this with a grain of salt. There is some expectation now. Maybe the September meeting is when they do a 25 basis point cut, or November. And then they say, it's 2 cuts by the end of the year. So now December is saying, hey, there will have been 2 25 basis point cuts. I mean, here's the thing with this. If imagine you were watching this and you traded based upon this. Remember, at the end of 2023, what was it? 6, 7 cuts was priced in. good luck trading off this. But I bring this up because it seems to be this narrative now that things are starting to get a little bit soft. So why is that? Well, one of the things we saw last week was the non-farm payrolls. I don't know. Why can't we include people that are on farms? All right, set that aside for a second. So the non-farm payroll comes out, and the number was 206,000. So when we say non-farm payrolls, it's how many what was the net change month over month in jobs? Great. More jobs, 206,000 more jobs than there were in May, because we're getting the June data. The other thing that came out was a revision lower in the numbers. So both April and May. So whatever their numbers were, they were revised lower. So April was down to 108,000 net new jobs. May was net new jobs to 218,000. Is this a big deal? A lot of people are pointing to this. All right. When you look at this number, I think there's a couple interesting things. One is that construction jobs have been one of the things they are adding the most. Education and health services, they've been pretty strong. What is this one here? Professional and business services was down 17,000 jobs month to month. Of course, month before it was plus 31, minus 17 the month before. Okay. I wouldn't read too much into this. And the reason why I say that is if you go back and you look long term, August of 23, you added 210,000 jobs. All right, what does that even mean? Well, March of 24 is 310,000. December of 23, 290. February 24, 236. November or October and November of 23 was 165 and 182 respectively. And those have already had their revisions built in. It's possible there'll be other revisions. But the reason why I bring this up is I think if you closed, just put your hand over the dates and you just look at these numbers and you would say, well, I don't really have a strong trend one way or another. When we think about the initial jobless claims, so those are initial jobless claims. You know what that is, right? That's people have now qualified for unemployment benefits and they're going up to the window. Kind of remember that, what was the movie? Cinderella Man with Russell Crowe. He actually goes up to the window. It was during the Depression. All right, set this. A good movie, by the way. I'll put a buy recommendation on Cinderella Man. That's probably from the 1990s, maybe early 2000s. I don't know. You can send me emails, derek.moore@zegainvestments.com. That's DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to get correct. All right. If we look at the jobless claims, anything that's kind of crazy here. All right. It was 238,000. Last month, 234. Month before that, 239. Month before that, 243, and so on and so forth. I would say it is more than we saw in 23. I wouldn't say this is anything too stark. What about GDP, gross domestic product? There's a number, we've talked about it before, Atlanta Fed GDP Now. It comes out and it's a nowcast. And a nowcast is basically taking the data as it comes in. It doesn't use all of the inputs, every exhaustive input for GDP that will be in, of course, the official final calculation. It's about 1.547. People are pointing to this and saying, look, it's slowing. All right. With a lot of these, I'm not going to say the C word, during the 2020, you know what I'm talking about. I don't want to get the Joe Rogan sticker, but it threw a lot of things off. And if you look at a chart at it, you see this massive down, this massive up, and then you kind of had this up for a bit. I don't know. I mean, it almost seems like it's normalizing. And if you look, 2011, 2012, and so on and so forth, like the growth is sort of there. And growth wasn't crazy big. I mean, we know that during the 90s and the 80s, we saw higher GDP growth. And of course, GDP growth is real growth, not nominal. There is a nominal GDP, but that's a different calculation. This is including or factoring in inflation. So, yeah, I mean, and I think if you look deeper in the numbers, what you see is that goods have been not as strong And we knew that. We knew that from the inflation data. We see services a little bit stronger, and there's different components there. Net exports make a difference because if you're exporting more than you're importing, then that actually reduces. It's subtracted, winds up being subtracted off of everything else. But is there anything in here that really points to recession? Look, I don't know when a recession. I almost can guarantee you. Guarantees are very few and far between in this business. But at some point, we'll have another recession. We know we had to wait 2008 to 2020. It was a long time. Some point in the future, we'll have another recession. I have no idea when that is. And picking these is very, very difficult, as evidenced by the 29 out of 30 leading economists. I can't let that go. I'm sorry. So I don't know. I mean, maybe growth is just normalizing. I have no idea whether a recession is coming or not. I don't. It just, if you try and pick that, I mean, how many times have you heard somebody say a recession is coming? Just look at the internet. They're telling you an 80%, 90% stock market crash is coming every day. And if you Google these same people for the last 10, 20 years, they've been saying it every day. The unemployment rate was interesting. Now, here's where you get a little rounding. I think the rounded number was something like 4.056 or 4.055 or something like that. So it rounds to 4.1%, which is the unemployment rate. There were a couple things interesting in there. The size of the population went up. The size of the working age population, so those that could actually work, those went up. And both unemployed and employed persons went up. And these are all ratios and numbers and things like that. So it seems like more people are coming into the workforce. And remember, the workforce, to be included in the workforce, you have to be either employed, okay, easy enough, or you have to be unemployed. And in order to be considered unemployed, you have to not have a job. And when they call you to do the survey and they say, hey, you have a job? No. Are you looking for one? Yeah. Did you look within the last 4 weeks? Oh, yeah. Great. You're unemployed by our definition. If they call and they say, do you have a job? No. Do you need one? Nah, I'm good. I'm not even looking. You are not you're not considered unemployed. So anyway, these numbers are so low anyway. I mean, do you go from, we've been under 4 for a while. I look back, April of 23 was 3.4. January of 23, 3.4. I mean, these are very low numbers. And so now we've gotten to 4%, which was in May of 24. The June number comes out 4.1. Again, they did round it up to be fair. And they always do that. So it's not like they did anything different here, but it is a rounded number. So I took a look, and there's different striations within the unemployment that you can take a look at. And one of them, the ones I pull up, is the unemployment rate for people with a bachelor's degree or higher. So do you have a college degree, a bachelor's degree, 4-year degree, or you have your master's or doctorate? That's just all these people that are in here. Even the lawyers. Well, I guess the lawyers would be in because they had to graduate college before law school, right? Okay, anyway. So the one thing I'll say about this is this number was 0.924%, meaning 0.924% unemployment rate for people with a college degree or higher. And I look back, and it actually is the highest that's been since 2021. And I don't know. I mean, this is one I like to watch because it's a little more, how should I say this? This cohort is, you think about a lot of people coming into it, a lot of people coming out, retirement age, new entrants coming in, it's just a little, in my opinion, it's a little bit more stable. I could be wrong about that. What do I know? But this is one I like to keep an eye on. And you might say, well, 0.924% doesn't seem like it's very high. And it's really not. And I will tell you that prior to 2008, the great financial crisis, this had gotten down to, I mean, it was less than 0.75. It was a little bit north of 0.5%, so 0.5%. It had been down, and then 2008, 2009 happens, and it took a long time to get back down just to under 1%. So, I don't want to do a whole show about people with bachelor's degrees or higher unemployment rate, but it is one that I watch and I find interesting. Okay. Next thing we got to talk about is Tesla. Tesla had been, they didn't have, when you think about the Mag 7, they did not perform the same as NVIDIA and Apple and Microsoft and the rest. Apple, by the way, made another new, I think it's an all-time high, but it's definitely a new high there. And, despite this, that's the funny, I shouldn't say the funny thing. All this talk about economy is softening. The stock market made a new high, made another all-time high. And I'll remind people that and I say this is I think there's a chance it goes to 6,000 this year. I have no idea if it's actually going to go there. That's why we buy, we hedge. We don't taking positions based upon what somebody thinks about the market. And in all fairness, if Jay would have went first and said it was going to 6,000, I would have taken the other side that it's not. So, but you look at this, another all-time high in the market. We close right around, 55, 68 or so, maybe a little bit south of there. But Tesla had been lagging. Tesla, it had to be up. I'm just looking at it here. It went to $251.52. And, at the end of, let me see here, what is this, June? End of June. Well, it actually started to go a little bit higher, but as recent as June 11th, it was 170 or so. So it's definitely come off the lows there, and it's broken out. I don't know where it's going to go from here, but this is a good example. Those of you who trade options, and we talk about implied volatility and volatility, and most of the time you think about volatility going up when the market is going down or a security is going down or right before earnings, those types of things. Well, this is a case where the stock was going up and volatility went up. And, I look at this and the implied volatility, actually the highest it got, I think it was Thursday, it was above 70%, it came back down about 68.3% right now. But, after the June low, that June 11th low, it got down to around 47%. And by the way, 47% is still high. And individual securities will tend to be higher than the market. The market right now is anywhere from 10 to 12%, depending on where you're looking on the option chain. But it's a great example of, yes, volatility can go higher when a stock is going higher or a market is going higher. And the reason why that is because partially the options market sort of votes with how options are priced. And so if you have a 70% implied volatility, it's basically saying that on any given day, the options market is pricing in a one standard deviation move of about 4.41%. So based upon what the options are priced at, what implied volatility is in that, and there's a big, Black-Scholes is one of the inputs, but there's also calculations to calculate or estimate implied volatility, a number of things. And to give you an example, what do we say, 4.41%? Well, at a 43% implied volatility, the one standard deviation expected move is about 2.71%. So it just shows you that the options market is now pricing their options for more of an expected move than it was prior, even though the stock is going up. So you can have volatility go up even though markets are going up or stocks are going up. And I thought it was an interesting example of that. Now, we're going to get into earnings season. And when we look at earnings, well, let me see if I can pull up when Tesla's earnings are. Let me see if I can do it really quick. If not, I will have to, give me a sec. I'll do this live. We'll do it live. Tesla expected, let's see, after the market, Tuesday, July 23rd. So there you go. I don't know what time the earnings call is. Probably after that. You can listen to Elon and company opine about their quarter. So, and I'll just mention that this Friday, earnings season starts, and quote unquote earnings season starts in earnest, meaning you start to get JP Morgan, Wells Fargo, the banks. I think Citigroup is that day as well. They'll kick it off, and we start getting a look at earnings. And earnings is a good segue because we've seen the markets make new highs, but the forward PE ratio, meaning whatever the stock market is divided by the earnings per share of the S&P 500, the expected forward 12-month estimate of EPS per share, which is 253.22 on the index, gets you just a hair below a 22 times forward PE. And the reason why I wanted to bring this up again, and let me give you some numbers too. The expected dividend yield for the next 12 months is about 1.39%. That can ebb and flow, but it's not going to change too much. And then forward 12-month growth and earnings growth, earnings are expected to grow about 10.89%. So why do I bring this up? A lot of people continue to talk about that markets are overvalued, that they are trading at high PE ratios. They'll talk about the Shiller P and all this stuff. And I don't want to try and make predictions about where markets are going to go. Markets can go longer than people think. They can go down longer than people think. And this valuation thing, I think right now, we've seen it with NVIDIA, where the earnings, as the stock has gone higher, the forward PE has come down. The forward PE has come down because the earnings expectations have gone up. So the reason why I bring this up is, if you think about where a market is and what would make it, what's sort of the explanation in a hindsight basis of where markets go. And let's imagine for a second that instead of being at a 21.99 multiple, imagine we were at a 17 multiple, and 17 times 253.22 would say the market would be trading at 4304.74. Does that mean I think it's going there? No, I'm not saying that at all. Just giving you an example. If it was only trading at 17 times forward earnings, it's the calculation would say it's 4,304.74. Right now at 253.22 times 21.99 gets you to about, the 55.68, right where it's trading right now. So the multiple has expanded. Earnings expectations have gone up. Remember, the forward PE is, what are your earnings expectations over the next 12 months? And so if earnings expectations go up, you can have the E go up, which is earnings. You could have the multiple go up. So, the price can go up, the earnings can go up, and price is sort of that multiple of the earnings, the expected earnings. So the reason I go through this, I'm always fascinated. So you say, okay, from here, what would make the market to go up? Okay, well, let's say the PE expanded from 22 to 23. So 23 times 253.22 is 5824.06. I'm not saying it's going to go there. I'm just giving you an example. So if the multiple expanded and the earnings stayed constant, the earnings expectations stayed right where they are over the next 12 months, the earnings, as we go through this quarter will be in the books, and then the next 12 months will be, Q3, Q4, Q1, Q2. Right now it's Q2, Q3, Q4, Q1. Okay. We're going to get earnings next couple of weeks. Watch for them. Great time of year to be an investor or someone who is interested in the markets. But if the multiple goes down, you would say, well, all else equal, if the forward expectations stay the same, the market would go down. The forward earnings expectations could go up or down. And assuming the multiple stays the same, well, that could make it, let's say 21.99 times. And imagine, their analysts come in and say, no, it's not 253.22. It's 255 now. Same multiple would get you to 56.07. All right. So when you think about to explain when a market is from one year to the next, what changed? Did the multiple go up or down? Did the earnings go up or down? Did the dividend go up or down? So the dividend yield, 1.39%, you sort of tack that on to any growth. And then one of the things we don't know as much is the expected buybacks. And so imagine if S&P 500 companies, and let's assume no companies came in, no companies left, it's the same companies of the next year. Imagine if the next year they bought back 50% of the shares outstanding. All right, well, if the EPS 253.22 is on a per share basis, if you have the shares and you kept the same net income, your earnings per share would go to 506.44, which, by the way, would be, they're not going to buy back 50% of the stock. But what if they buy back, I don't know, 4% of their stock, 3% of their stock? Well, what you can kind of do is you take the 253.22 times, let's say 1.03. You'd say, well, the earnings per share would go up to 260.81. So stock buybacks or issuance, in the 2000s, the early, 2000 through 2009, there were not net buybacks. There were net share issuance because you had a lot of tech companies and they were doing things like issuing shares to do stock-based compensation. So net buybacks is what is important. But that's the other. So when you're thinking about a market, and I'm not trying to make a prediction, you're trying to say, what's the multiple going to be? What is the earnings going to be? What's the buyback yield, meaning how much stock will companies buy back? What's the dividend going to be? And this is why when people make predictions, when they're making a prediction in January for what the December 31st price will be, essentially what they're saying is, I'm predicting what the forward multiple will be on December of 2024. And I'm predicting what the forward 12-month earnings estimates will be. Because you could get the estimates right, but get the multiple wrong. You can get either one wrong. But it's just a reminder of sort of the way I learned to, on the fundamental side, I'm a technician at heart, but the fundamental side. And you kind of look and you say, okay, how much can the valuations or the multiple go up? How much can the earnings change? And if you're interested in markets, we're about to get a really good look as the companies open the books for you and show you and tell you what they earned. And maybe they give you a little insight about what they're going to earn in the future. The other wild card of this whole thing, and I always talk about this, and I don't know why people don't talk about it more. The S&P 500, when you look at the total net income, it's the aggregate of all of the companies that that are actually in the index, and they all throw the earnings in one big bucket, and they all share the earnings. That's how it works. So wouldn't it be reasonable to say, well, what if some underperforming companies or smaller companies come out and new companies come in, and the new companies might not do as well as the old companies. We don't know, but that is an talked about aspect of the S&P 500 future growth of earnings. For example, most recently on June 24th, there were 3 companies added and 3 companies that were removed from the S&P 500. KKR took the place of RHI, which was, what's RHI? Robert Half. I don't know what that company does. I'll be honest with you. Sorry if you're the founder of that company or you're the CEO, or you can send me an email, send me your info. I don't know. CrowdStrike was one that was added, and that was one, they took out Comerica, and then GoDaddy was added, and they took out Illumina. So companies are coming in and they're leaving all the time. I shouldn't say all the time. And, we saw some in June, we saw some at 8. And when you see ones that are, pop up, a good example is, so Pioneer Natural Resources was removed on May 8th. And the reason is ExxonMobil acquired Pioneer Natural Resources. So their stock no longer trades on its own, probably, and Exxon now owns them, so they're not going to be around anymore. You might see companies due to a market capitalization change. The S&P 500 are large cap companies, they're U.S. companies. You might remember back in March, Supermicro, a semiconductor company, and manufactures stuff. I mean, they're in Silicon Valley, they're a technology company. They came in and Whirlpool left. So I don't know. I mean, these are interesting things to me because, and I didn't do a comparison of, let's say, CrowdStrike versus Comerica or KKR, but you can kind of look and you say, well, let's look at the new companies that are coming in. What are their revenues? What are their earnings? And what were the old ones that went out? What was their revenue? What were their earnings? So the idea that, and this is really an argument for indexing, and we like to own the S&P 500. We like to hedge it. We like to buffer it. That's some of the core things we do. We do a lot of other things, certainly now, but that's really the core thing, this buy and hedge mentality or buy and buffer. And, these companies that are coming in, you have to reach a market capitalization. In other words, you have to grow yourself into the S&P 500. And so it's just a case where you say, indexing really, it takes the companies that are growing. You own more of the companies that are the larger market cap. So in some ways, and I don't want to say owning the S&P 500 is like being a trend following strategy, but in some ways, I mean, you own more NVIDIA if you own the S&P right now than you did when NVIDIA was lower in price. And you've added to it as it's gotten bigger and bigger. So, all right, that's the other thing. And it's never really talked about, but I'm really interested in things like that. Because when I look at companies I pull up a comparison of the two and I say, oh, that's interesting. Look at the earnings that are going to come in, or look at the revenue, or, what's the expected growth rate. So that index is always moving, and you may not realize it, but the same companies that were in that index 20, 30 years ago are not necessarily the ones that are in there now, and there'll be new ones. Uber was added. When was Uber added? Uber was added, when was that added? Let me see here. Yep, December. And Sealed Air, don't know what that company, I imagine something to do with air and sealing air. Ha, there you go. All right, anyway, that's going to be it for this week. Recommendations. I did get through season 3 of The Bear, and I thought it was really good. If you're a fan of the show, you'll like the season 3, and it sort of gave you a lot of the backstory. How do I do this without giving it away? Well, I have to look up. I wonder if they've actually filmed 2 seasons at the same time, and we're going to get another quote unquote season 4 sooner. I don't know that. Send me an email, derek.moore@zegainvestments.com, if you know that answer. But I thought it was really good. I think it's worth, if you haven't watched The Bear before, it's on Hulu. And I finally bucked up and did the I couldn't figure out how to add it, how to get rid of the commercials, but you pay a little bit more every month and there's no commercials. And I would strong buy recommendations on getting rid of commercials on your streaming channels. So anyway, all right, that's it. Like I said, Jay will be back at some point. Appreciate people reaching out, as always, giving me ideas. I do have, I said this last week, there's some questions that people have been asking that I'll get to. Maybe next week we'll bring in some more listener questions. That will be a good time to do that. Also, watch out for the inflation numbers next week. Oh, actually, don't watch out for them like they're going to hit you or hurt you. I'm just saying they're coming out, and you want to see what's going on with inflation. The Inflation Nowcast. All right, this is from the Cleveland Fed. Before we leave here, let's just go through this. The June CPI month over month is expected to be 0.07% month over month. Core CPI 0.28%. Nowcast, again, they just look at the data as it's coming in, and you sort of want to watch these for trends. If those numbers came in, the expected CPI year over year for June would be 3.12. Core CPI would be 3.52. Core PCE, which is not till later in the month, that comes out 2.61. Interestingly enough, I mean, they already have some estimates for July. We're like a week into July, by the way. So take these with a grain of salt. You want to watch the trends. You want to watch this over time. But they actually have July CPI going back up to 0.24% month over month, and the year over year going up from 312 to 316. Both of those are estimates. Estimates can be wrong. They can be off, as we're seeing with the Bloomberg Economic Surprise Index. Apparently, the experts have not been as expert at picking things lately. All right, rather than spend another 20 minutes, 30 minutes deep diving the election probabilities, plenty of that elsewhere, but we will have a show. I don't know, maybe with all that's going on, we'll have Spencer and I will do a little segment sooner than our election predictions, where of course we'll probably be wrong again on those, but look for that as well. All right, talk to everyone next week.